Hello and welcome to our discussion on variance analysis for managerial accounting. So in this chapter, in this discussion, we're going to be talking about things such as the quantity variance, the price variance, all those topics for materials, labor, and overhead. So as an overview here, we know that when managers are reviewing the information from their internal accounting systems, they need to be able to make sure they can control the various other managers, the employees, the activities in general. To be able to control, they have to be able to compare what's actually happening to what was supposed to be happening. So they need to take a look, is everything going according to plan, or are we over budget, under budget? So we're talking about accountability, holding other users accountable for their responsibilities. Now, before we get into the details here, we have to talk about this concept of management by exception. What this basically means is that if you have, let's say, a larger company, you're going to have a top group of management, but they don't want to see the great details of every single area down the line. It's just too much to try to do anything with. They've delegated the authority to mid and lower level managers, and they're supposed to control their own areas and then just send a summary of the results upstream. So they don't need to see the detail, they need to see the summary, and more importantly, they need to know, is anything not going according to plan, because that's what's going to need their extra effort to try to fix. Now, so the underlying assumption is that unless we hear otherwise, we'll assume things are going according to plan. That's basically management by exception. We need to spend time on those items that need to be corrected. So what we have here is just a list of various responsibility centers that we could be talking about. We're talking about accountability, who's accountable for what. In the cost centers, which are generally the more common type of responsibility centers you're going to see in a company, we're talking about areas that don't really have any revenue themselves. They're supporting other areas of the company. And as a result, the only thing they're going to have is cost. So their responsibility is to keep cost to a reasonable level. So we're talking about areas like accounting, assuming this is not a CPA firm that sells the accounting services. It's just an internal type accounting area. Maintenance, production departments, anybody that does not generate a revenue directly. Then we have revenue centers, which are actually a little bit unusual, and they're probably the least common of this group. To actually separate this into a center, their goal is to keep revenues high, according to whatever the budget is. So you can't say that they have zero cost, whereas with a cost center you can say they have zero revenue. But with the revenue center, you can't say they have zero cost. It's just that the cost is not as important, and we're not focusing on it. So these are areas like the sales departments, or reservations departments. So their main focus is generating revenues. The costs they might have some overhead costs, some computers. They'll have some staffing costs, some labor costs, but we're not really focused on that. Their main focus is generating revenue. So we're not going to bother to measure cost, or at least hold them that accountable for it. Certainly they'll have a budget, but that's not our focus. With a profit center, it's a mixture of these other two, cost and revenue centers. Think about a fast food restaurant, or any restaurant, any store, but the restaurant's a good example because we're talking about both keeping costs low, like food cost, labor cost, and keeping revenues high, generating more sales, keeping the customers happy. The manager of this fast food restaurant is accountable for both, and by controlling both, they keep profits higher. So you might see a situation where they, for example, the food, they want to make sure they're only using the level that the recipe requires. Think about a pizza restaurant. You don't want to be throwing too much cheese on there, too much of the meat. You put it according to the recipe. You don't want to skimp because then the customers will be dissatisfied, but you don't want to put more than expected either. Staffing. This could be a situation where the supervisor for that shift is running a labor report every hour comparing sales to staffing, If sales are lower than expected and there's no expectation that they're going to get higher throughout the day, they may let some people go for the day, go a little early. Of course, generating higher revenues would be to satisfy customers, do anything you can to advertise yourself, get word of mouth advertisement to generate higher revenues. So this is the way that a profit center manager would track that. With the investment center, this is like the headquarters of the fast food restaurant that has many different stores in the chain. They're going to take the profit from all of the individual fast food restaurants, and their responsibility is to reinvest it. So, for example, they may want to invest it in opening a new store, researching a new product line altogether, or they may just buy stocks and bonds of another company and see what type of return on investment they could get. So these are the 4 responsibility centers we're talking about. Now we'll move on to another topic here. When we talk about the static budget, or when we talk about the budget in general, we have to know exactly what we're talking about. The static budget is what people tend to think about with a budget. The budget committee or whatever work group gets together and they identify what revenues do we think we're going to have and what costs correspond to that, and they generate a static budget. It's a predetermined level of activity. So if we have budgeted for 90,000 units, but we actually sold more or produced more, 100,000 units, we're still going to stick to the 90,000 unit budget. Even though we sold more and things are expected to change at that higher level, we're still comparing to the 90,000 unit dollar amount. So we're comparing our sales at 100,000 to what we expected them to be at 90,000. Obviously, sales are going to be higher. We're comparing costs at 100,000 unit level to what they were expected to be at 90,000 units. This is where it gets a little bit skewed, because think about materials especially. If you're producing 10,000 more units than expected, it's a guarantee you're going to have more materials than what you expected at the lower level. Because you have more cost, it seems to be unfavorable. More cost is not a good thing, but in this case, it's expected. But if we're just comparing against the static budget, we're not going to take that into consideration, and you're going to have a skewed comparison. A flexible budget, on the other hand, it adjusts the revenues and costs to the level of actual production. Now, I don't mean that it just takes every single number and just says, our budget was actually what our actual was, then there's never going to be a variance. We're not saying that by any means. We're saying if we expected a certain amount at 90,000 units, then what should we expect at the actual level of 100,000 units? How much cost per unit? How much revenue per unit? So that's what we're doing with a flexible budget. We're taking a look at unit standards that helped us to derive the static budget and apply those same per unit standards to the new activity level. To do this, we have to understand what is the fixed cost versus the variable cost. So fixed costs wouldn't be expected to change at different operating levels. Variable costs would. So that's what we're getting at with this discussion. Now, I briefly talked about this. I jumped to this concept earlier. We're talking about variances. So we're comparing the difference between the actual and expected results, or actual results and budgeted results related to cost. The important thing to understand when you get into this topic is that we're always going to throw this out as a positive number. In other words, we're never going to show it as a negative number. That's just the definition of absolute value, if you've heard that phrase before. We're saying we're reporting everything as an absolute value. The difference from the budgeted amount. Whether it's good or bad, it's what difference, how far away was it? Because of that, we have to understand the concept of favorable versus unfavorable. We're not calling them positive or negative. We're calling them favorable versus unfavorable. Favorable obviously means a good thing. Unfavorable, not a good thing. Now, when we say good or bad, we're talking about its overall impact on net income, because generally with these variances, we're talking about revenues versus expenses. So more revenues is going to be good. It's favorable. That impacts net income positively. More costs, on the other hand, even though it's still more revenues, more costs is not a good thing because it's going to reduce net income. So that's unfavorable. Now, on the other hand, less revenues is unfavorable, less costs is favorable. So you have to consider, how does this impact net income? So to start this off, we have to look at a total budget variance. This is the total difference between the actual and the budgeted or standard amounts. With most items, virtually all items, we're going to have two things causing that budget variance. If it's going to be a quantity of the item used, whether that be the amount of materials used was more than expected, or the amount of labor used was more than expected, the labor hours. It's a quantity. But we also could have price. So, hey, we used the proper quantity of materials, but the price per unit came in higher than expected. Or we used the proper amount of labor hours, but we hired unexpectedly more costly labor. So one of those two things, or both of them, is causing our variance. And this topic, this discussion in this slide, or in this presentation, is really all about understanding how each of them interacts and focusing on each one individually. We could be talking about materials, labor, or two types of overhead, variable and fixed. So this is what I'm getting at with the overall variance here. This is just a basic equation, by the way. I'm saying cost and quantity. So on two different sides, we have the actual cost and the actual quantity. If you take actual cost per unit multiplied by actual quantity, you're getting total actual cost. On the other hand, if you take the standard cost per unit multiplied by the standard quantity allowed, you're getting the overall budget. So if you just compare those two extremes, then you're talking about the overall budget variance, the total budget variance. But again, knowing that doesn't really help you. You want to know what caused it. Was it the price change that caused the variance? Or was it the quantity change that caused the variance? Did you use too much of something, or did you get charged more than expected? Or less. It could be either way. So to do that, to get a price variance, we have to know the difference between the two prices, actual and standard. So this cost, by the way, is cost per unit. The quantity is still actual. It's actual in both cases. Now we're going to see this in a different format in just a bit, but these two give you the price variance. If we instead want the quantity variance, we need to know the difference between the two quantities, actual versus standard. But the cost is going to be standard cost in both cases. So over here, our item that was the same between the two was actual, and that was the quantity. Over in this quantity variance, the two items that are same as the cost per unit or the price, but they're standard. So one's actual, one's standard. It's just mathematically the way it has to work to be able to add these two variances up to get one total variance. So let's talk about how to work this out, how to calculate variances. Any problem that you get out of a textbook or in real life, you may get these items in a different format, but what we need to know is, regardless of what we get, we need to calculate these four items. We need to be able to calculate the standard cost per unit, whether that unit be a pound, a foot, hours, whatever we're talking about. What's the standard cost or price per unit? Sometimes they'll give that to you. Sometimes they'll give you the overall standard cost for X number of units, and you have to divide it by that number of units to get one unit's standard cost. You need to know the actual cost per unit. And again, they may give you just how much you paid in total for 1,000 units. Divide that amount by 1,000 to get the actual cost per unit. Sometimes they'll give you the actual cost per unit. You don't have to worry about it. Then we need to know, this one's the trickier one. You need to know the standard number or quantity of those units. So remember, the first two was cost or price. Now we're talking about quantity, the standard number of those pounds, hours, whatever. needed for not just one unit, but the actual level of production you're operating at. So that's why it's tricky. For the first group, the cost, we were looking per individual unit. For the quantities, we're not looking for one unit, although we may need that to start with. We need to know how many units were expected for this level of production that we're actually talking about. Just as an example, if it takes 2 pounds of material to make 1 unit of product, and our actual production was 200 units, then we're going to multiply 200 units times 2. We expected to use 400 pounds of materials. That's what we would need for this item. Now this bottom one's not so bad because it's the actual number of those items used for this actual level of production. They're generally going to give you that. They're going to give you that full-blown number. But they may indeed tell you that we actually use 2.2 pounds of something per unit. Just multiply it by the actual level of production. Understanding this is key to working forward, because you're going to have formulas, but you won't know what to do with the formulas until you have these items. So spend plenty of time thinking about this, analyzing any problem that you have to get these 4 items. And again, here's a summary of how you may get the data. The other thing I want to talk about here before we move on is terminology, because I've seen several different textbooks, and unfortunately they haven't all used different terms, but I've seen multiple terms for each item, depending on whether we're talking about materials, labor, overhead. I like to boil it down to 2 things using a generic term. Price variance, whether you want to call that the cost per unit, whatever, it's the price we paid as a company for that item, that input, that material, that labor. And then the quantity variance. How many of those items did we use compared to what we expected to use? The price variance you may hear referred to as a few different things. Rate variance, spending variance, cost variance. They're all the same thing. They're dealing with the price per unit. Quantity variance, I've heard a couple of different terms. Usage variance or efficiency variance, because we're being efficient in how much we use. Just think of it as a quantity variance. The same model that we're going to see in just a bit works for direct materials, direct labor, and variable overhead. But fixed overhead has to be looked at separately because it doesn't quite follow the same model. And we'll see why later. So here is, for materials, labor, and overhead, what you might hear them referred to as. A lot of times you'll hear it called a materials price variance, or a direct materials quantity variance, direct labor price variance or rate variance, direct labor quantity variance or efficiency variance, and then you'll have your variable overhead rate variance and variable overhead efficiency variance. Again, this is just some examples of what you may see. Now, here is what we're going to have to do to calculate the actual variances. This is probably what you're more concerned with. For the quantity variance, keep in mind we're talking about a variance between 2 quantities. So those are going to be the items we subtract. Standard quantity minus actual quantity. But that by itself doesn't give you anything. You have to turn it into a cost by multiplying it by a cost per unit. So the focus is on the difference in the quantities, which is why it's called the quantity variance. Multiply it by a cost per unit to get a price at that level. Now again, I do want to reiterate, the standard quantity we're talking about is the total amount for that current activity level. So how many pounds did we expect to use per unit, but multiplied by the number of units? And then how many pounds did we actually use for that actual level of production? For the price variance, it's the standard cost or price per unit minus the actual cost or price per unit. So the difference is now between the 2 prices or costs. But again, by itself, it's going to give you maybe 10 cents per pound. That doesn't mean much. we have to multiply it by the actual quantity used to determine what that little variance overall cost us. Here's another way of looking at it, boiling it down to just some little abbreviations or acronyms here. The price variance has your difference in two prices multiplied by the actual quantity. The quantity variance has your two different quantities multiplied by the standard price. One of the tricks is, again, remembering for the item outside of the brackets, is it actual or standard? For the price variance, it's the actual quantity that's outside of the brackets, actual. For the quantity variance, it's the standard price that's outside of the brackets. So let's take a look at a data set here. We actually produced 7,500 units this month. The actual amounts used were as follows. We actually used 7,500 pounds at $2.25 per pound. So they gave us the actual amount the actual price per unit, but they gave us the total pounds actually used. And actually that's what we need. We need the actual total amount used at the current level. So we would just take this 7,500, but if for some reason we wanted to know how many pounds do we use per unit, you'd take 7,500 pounds divided by 7,500 units. We used 1 pound of material, and that's fine. So, but ultimately we needed this total pounds used at the level. Direct labor, it's the same basic thing in this case. They gave us 27.50 hours at $10 per hour. We need to know this 27.50, but if for some reason we wanted to back into how many hours did we use per unit, we could just take 27.50 divided by 7,500. We just don't need that for this problem. Variable overhead, they give us a total amount used. They don't give us a rate, and they don't really give us a quantity. But what we're going to find out later is that for this situation, we're measuring overhead use based on direct labor hours. Even though it may not have a good correlation, that's what a lot of certainly textbook problems tend to use. So we can calculate an actual rate because we know we use 2,750 labor hours, which is also what's going to be used to apply overhead. So we can take 5,500 divided by 2,750 to get the actual rate per unit. Now remember, for price variance or rate variance, we do need the actual rate per unit. So we will have to do that to back into that number in a bit. Fixed overhead we're going to talk about separately, so we'll leave that alone for now. Those were actuals. Standard amounts per unit, we expected to use 1.25 pounds of material per unit at $2 per pound. So let's just think about it for a minute. The $2 per pound, that was our standard. We actually used $2.25 per pound. We used more than expected. Remember earlier I said this actual usage means that we only used 1 pound per unit. We were expected to use 1.25 pounds, so that could be a good thing. We use less material. As long as it doesn't cause us quality issues, that might be a good thing. Direct labor. We expected to use 50.50 direct labor hours per unit. We expected to have 10.50 per hour. We actually had less of a rate per hour, so that part by itself may be good, but we'll get to that a little bit later. Variable overhead, it had the same amount of hours expected because, again, we're using the same base. We expected it to be $2.25 per direct labor hour. We really didn't calculate the rate yet. The actual rate we could have. We just briefly discussed it. We'll get to that part in a bit as well. And then fixed overhead, I'm just going to ignore that for now. We'll talk about that in a later discussion. So we planned to use 5,600 units. Now, by the way, this 5,600, a lot of times they'll give you that. The reason I say this tells us that we plan to produce 5,600, you have to actually look at this fixed overhead to identify where I got that from. It's not a main part of our discussion, but what I'll mention here is that we know that we have to use, or we're expected to get $8,400 in fixed overhead overall, And by the way, this should not be a dollar sign. It should be 0.50 direct labor hours were expected for every unit, multiplied by $3 per direct labor hour. In other words, 3 times 0.5, we expected to use $1.50 of fixed overhead per unit. If you multiply that by 5,600, or actually if you take 8,400 divided by 1.5, you'll get 5,600 units. But you don't need to spend too much time on that because they'll probably give you the 5,600 units. Just kind of keep that in the back of your mind. So remember, to do our calculations, we need to know the standard cost per unit, actual cost per unit, standard number of the pounds, hours, whatever input we have needed for the actual level of production. We may need to know how much for every individual unit, but we ultimately have to multiply it by the actual number of units produced to get this. And then we have to know the actual number of pounds or hours actually used for that actual level of production. So let's take a look at how we get all those items. Actual cost per pound, if you go back a few slides, they gave us $2.25 per pound. They gave us that cost. They also told us we used 750 or 7,500 pounds at actual production. Now the standard cost we were given as well, and we said it was $2 per pound. So right away, we can see the difference between actual and standard cost, but we'll see that in a bit. Now we need to know the quantity of pounds actually used at our production level. So for that, we have to look at the standard cost. We were supposed to use 1.25 pounds per unit, multiplied by 7,500 units, and that gives us 93.75 that we were expected to use. So now we have all of the information we need to work our variances for materials. So again, our formula is the difference in the two prices, actual minus standard, multiplied by the actual quantity. So from back here, we had $2.25 and $2. So it's a quarter difference. We actually spent 25 cents more per unit than expected. We have to multiply by the actual quantity of materials used, which was given to us. Now, keep in mind, it's just coincidental that this quantity also matches the total number of units produced. It's just because it was 1 pound per unit. But what we need is the actual quantity of pounds per material. So 7,500. Now, what that means, by the way, before we even get to the item outside of the brackets, we can tell immediately whether this is going to be an unfavorable or favorable variance. Actual price is higher than standard price. More cost or more price is a bad thing for materials. So it's going to be an unfavorable variance right off the bat. The only question is, how high is it? How big is that variance going to be? That's when we have to multiply by the quantity. We end up with $1,875 spent that was more than expected. Therefore, it's unfavorable. Now let's look at the quantity variance. The price caused an unfavorable variance, but we have to look at the quantity variance separately. So here, the difference in our two quantities, we actually used 7,500 when we were only expected to use, or when we were expected to use 93.75. We used less than expected by a good chunk. So that's going to be a favorable variance, but to identify how favorable, we have to multiply it by the standard price of $2 per unit. So the $2 multiplied by the 1,875 units is $37.50. So that's what the quantity variance was. We used fewer pounds. That gave us less cost, which is a favorable variance. Now let's look at labor. So we have actual and standard, again, amounts. The cost per hour was given to us, $10 per hour. The quantity of hours used at actual production, they also gave us 2,750. The standard cost per hour was given to us, although it may not always be. We may have to back into that number. The quantity of hours used at the actual production, remember we had 7,500 actual units used. You may recall from that data set earlier that it was 0.50 hours expected to be used per unit. This gives us 3,750, which it actually is labor. We're going to see this, that it's going to be the same as overhead later on. So when we do the calculation there, it's the same basic calculations. We're just plugging different numbers in. Now the difference between our two prices is 50 cents. We used 10. We were expected to use 10.50. We used 50 cents per hour less. So it's going to be a favorable variance. We have to multiply that by the actual quantity of 2750, and we get an overall variance of 1375. We had a lower rate, gives us less cost, that saves us money, it's favorable. The quantity variance, or the differences between the two quantities, we had the 2,750 hours that were actually used compared to the 3,750 expected to be used. We saved 1,000 hours. Multiplied by the 10.50 standard price per unit, we can see up here as well, gives us $10,500 of a favorable variance, savings. We used fewer hours, saved us money. Now we're going to talk about the variable overhead, which some of this will match the labor, but not all of it. We had to back into the actual rate per hour for this. And if we go back, we saw that the total actual variable overhead was 5,500 divided by the actual total hours of 2,750. We get a $2 rate per hour of actual rate. The quantity of hours used at the actual production is going to match what we had for labor. The quantity has to stay the same as labor since we're applying variable overhead based on hours. For standard, the cost per hour was given to us earlier, $2.25, but we have to calculate the quantity of hours actually used. And just as we did with labor, it's the same thing. 7,500 actual units, we actually used 0.50 hours per unit. That gives us 3,750 actual hours used. Here we're back to the same basic calculations, same formulas, although we have different inputs. We have a 25-cent price difference between the actual price and the standard price. Now notice the price isn't the same as the labor. The quantity is, but the price isn't. So 25-cent difference in the rate. Actual is less than standard. It saved us money. Favorable variance. Multiplied by the same quantity as we used in labor, 2750, that saved us $687.50. The quantity variance is going to be the same quantities as labor, 2750 versus 3750. You may recall that $1,000 difference, but now the difference is the price. It's going to be multiplied by the standard price of $2.25 to get a $22,500 variance. It's going to be favorable because it saved us money. We used fewer hours. So now we're moving on to a completely separate topic with fixed overhead. You can't follow the same model as before. It has two variances related to it, but they're not price and quantity. They're completely separate. The first one is called the budget variance, which is actually the easiest variance out of the entire group because they're just flat out $2 amounts. So we're comparing actual total fixed overhead that we used minus budgeted total fixed overhead we expected to use. We budgeted for $8,400, and by fixed overhead we're talking about things like depreciation, salaries of maybe our managerial staff, supervisory staff. Those things aren't expected to change with the activity levels. So generally these should be pretty close. The fact that there's a fairly decent difference here is a little unusual. It means that for some reason we spent more than we budgeted. Now, it could be we decided to give our supervisor an unexpected raise, but it has nothing to do with activity level. It's just the price was higher. Maybe we bought a piece of equipment that we didn't expect, therefore we had more depreciation. There are a variety of things that could cause this, but it's not explained solely by a change in activity level. The volume variance is the unique one here that we have to really think about. What this is budgeted fixed overhead minus allocated fixed overhead. So it's still the same budgeted fixed overhead from up above, which would be $8,400 in our example. It's right down here from up here. But we have to look at what did we allocate. Now, earlier I gave the data for this. I said we were going to really kind of ignore it for a while. But let's go back and take a look at it. We said it was 50.50 direct labor hours at $3 per direct labor hour. That's the amount per unit. And we actually used 7,500 units. So we would have allocated basically based on 150 per unit multiplied by 750 units. So that's what we have here, the 0.50 hours per unit multiplied by $3 per hour, 150 per unit, multiplied by 7,500 actual units produced. What we end up with is $11,250 of allocated fixed overhead. We budgeted for $8,400, but we actually allocated $11,250. This is a $2,850 variance, but the question is it favorable or unfavorable? There's nothing inside of the brackets per se to look at to define that. So what we have to think about is the nature of fixed overhead in general. We have a set amount that's not supposed to change based on activity levels. We think it's going to help us to produce, 5,250 units. So we think we're going to be able to use that equipment to generate 5,250 units. Somehow, without paying any more money than expected, we were able to generate 7,500 actual units. So with the same equipment that was expected, all of that, we were able to generate 7,500 actual units. To me, that's a favorable variance. We were able to use our fixed overhead to produce more than expected. That's a favorable variance. You'll see some textbooks that tell you they can't really call it favorable or unfavorable because it's not controllable by activity levels. But to me, we're managing our capacity more efficiently, and therefore it's a favorable variance. That's my take on the matter. And that takes us to the end of our discussion on variance analysis. Hopefully these calculations will help you through any problem you may see. I just tried to explain it a few different ways because I know different textbooks, different problems in general, including real life, give you this data in different ways. So again, hopefully this has helped, but thank you for your time. Thank you for watching my accounting video on YouTube.com. I hope you've enjoyed that information. Accounting can be a difficult topic to conquer, and sometimes you just need additional information or assistance outside of the classroom. If you feel like you need some additional information, some additional resources, come visit my udemy.com course. I have a variety of financial and managerial cost accounting courses available that may be able to assist you if you're having trouble with a particular course. In these courses at udemy.com, I have additional lectures on a variety of accounting topics. We also have downloadable Excel templates for all of the various practice exercises we work, as well as a video walkthrough of the solution. I continue to update these practice exercises, so even after you join, you may see some new exercises. It's all geared toward helping you to understand the topics. So in addition to those additional lectures and the practice exercises, we also have quizzes and tests to help gauge your understanding of the topic. That may give you a better idea if there's something you need to go back and learn a little bit more about, read more about, watch a video on. We also have downloadable study notes that really try to drive that home. There's a downloadable textbook with it. So feel free to come join this class, come take a look at it. You can find this at udemy.com if you search for Severson, or you can just Google Severson Udemy Accounting to see a list of all the courses that are currently available. Again, I'm working on new courses as we go. Right now, you'll see some financial and managerial accounting courses out there. I'm working on the intermediate and advanced side of those particular courses as well, so you may see new ones out there as well. Now, email me for a special 50% off coupon code. You can send an email to chrisseverson@hotmail.com, and I will respond with that code. It's a different code for every course, depending on which one you want. I can also respond with the actual link to that course. Now, all courses at udemy.com have lifetime access, and there's also a money-back guarantee if you're not satisfied. So come check out my course at udemy.com and see if it may be a fit for you. Thank you for your time.